Hey, hi everyone. So as I promised that I will do this EFN calculation for you so that I don't have to spend too much class time for this, which you have done for your in-class work already. So basically I've used AI to convert it takes even 2, 3 minutes to convert everything into Excel, and then we go from there. Okay, so you can see we have um, the income statement here on the top for 2 years. And then we have the balance sheet starting from here, and then the other information if we need them. So the main point is calculating EFN, which is external funding needed. So for that, we have to project 2023. So look, I will not be focusing on formatting or anything at this point because that depends on individual and sometimes individual firms. But it's always a good idea if you ever work on Excel to keep things neat, or maybe an assumption sheet where the assumptions are coming from. So I can change one of the assumption, everything changes. So, or you can keep them at the top at a minimum. So let me show you what I do. So let's see what kind of data I have. Most of the time in EFN, your most items of income statement and balance sheet are pretty much grows by sales unless otherwise is stated. So let's see. Let's see what kind of information we are given. So let me see if I'm sharing the right thing. Yes, I am. My screen. Okay. So sales growth of 2023 is supposed to be 20%. And then some of the items are percentage of sales. I know the language could have been better, which I've taken note. Depreciation amortization says percentage of 2022 net PPE. So it basically means that depreciation of 2023 should be a percentage of net PP of 2022. So that gives you a hint that 2022's depreciation is a percentage of net PP of 2021. Why? In general, that whatever the asset you end with, let's say 2022 ending, that assets depreciate in 2023, right? So based on that understanding, same for interest expense, whatever long-term debt you end with of 2022, you pay interest the next year, right? Taxes, preferred dividend, we're gonna keep the same. Cash, mostly percentage of sales. Cash equivalents are percentage of sales too. We'll keep short-term investment same. Majority of the other item accounts receivable, inventories, net PPE, accounts payable, percentage of sales. Here is a note there. What if I give you both gross PPE and less accumulated depreciation, which gives you net PPE? Generally, when we forecast as an analyst, gross PPE is the percentage of sales. And the less accumulated depreciation should be whatever depreciation, accumulated depreciation you had from last year, plus the depreciation of this year, right? So that will give you the net PP. That's another way of doing it. And preferred approach of doing this. I just kept things simple. Notes payable, we're going to keep it same. I'll explain why. Accruals, which is basically salaries, expenses, and all the other things, are also percentage of sales. Any other kind of external funding, long-term bonds, preferred share, common share, we're going to keep same. As you know, return earning is always last year plus net income of this year minus if you pay any dividend. So if the question doesn't say anything about preferred share dividends or common share dividends, you keep it same as last year or keep it zero. That if the assumptions say nothing, it's better to keep it zero. That means the company did not announce any dividends and then they're not going to pay. You can argue that the preferred share dividends need to be paid every year, and otherwise that gets accumulated, which is why most preferred shares are called cumulative preferred share. So we're going to make an assumption here that preferred shares are getting paid as long as you have enough net income to pay that. If not, it will accumulate. And common stock dividends, if it doesn't say anything, you don't really have to pay common share dividends. We can just keep it zero. Let me tell you why. EFN means when you need external funding, right? So if you need external funding, does it make sense to pay common share dividends for a normal company? Even if a company is paying, maybe they are due for a long time. Maybe in the AGM, shareholders voted that they want dividend. But nowadays, most tech companies don't, right? So they rather reinvest, which has a positive impact on on share price that we will discuss later when I teach you cost of capital. Okay. The other thing we will see why EFN is total asset minus total liabilities and equity. Some of you asked me that question in the class. Look, 2023's forecasted statements are not true statement. That's what you're assuming you're going to have. So you need assets to grow your sales, isn't it? So let's say you want to sustain a 20% sales growth. So if the assets are, let's say, 1 million, and the liabilities or equities forecasted are, let's say, 0.9 million, which tells you I need 100,000 more liabilities and equity to have that 1 million asset to grow by 20%. If you don't need the money, that means you have a surplus fund which can be invested in short-term investment. By the way, your balance sheet won't balance. So the way you balance the balance sheet is if you see the total asset is bigger than total liability, which means you need funding. So you add the difference, which is EFN, under notes payable. That means you're borrowing money. You can also argue, Emrul, why not long-term bond? Why not preferred share? Why not common share? Right? So yeah, those are possible too. But for a short-term funding, you generally go with notes payable, a line of credit, etc. Later, we will learn when I talk about capital budgeting that for long-term asset, like 5 to 6 year or more year, like if you're buying an equipment, if you're buying a warehouse, you're expanding into a country. For those, you generally, for cash flow matching principle, go with long-term liabilities such as long-term bond, preferred shares, and common share. But year to year, you generally cover those extra area using notes payable or again, if the notes payable coming from accounts payable, that's a whole different story. But here we are making an assumption that notes payable is very similar to, let's say, line of credit that you take from bank, because we put notes payable under current liability, if you remember. Okay. So again, I talked a lot, but that's how it works. I'm talking fast because I want to keep the video short. Okay. So let me show you how the sales growth part drives everything. So we're going to write sales growth, and it's best to connect. Okay. I'll show you how to connect things. So net sales would be 20% more than that. I think you know already. But I need a kind of a common size income statement to know what is the percentage of each item of sales, because I need to apply those percentages also. Okay, you can always put a, I wish I was using my MacBook, doesn't have the charger right now. Anyway, so I fixed the net sales and you expand it. Okay, so now everything is a percentage of sales. Oh my God, I don't like Surface Pro. Anyway, so this is a common size income statement which shows you everything as a percentage of sales. Here we can just grow things as a percentage of at 20%. That's okay. And look, this 20% number needs to be connected. I'll show you how. So first of all, sales growing by 20%. So these times you should do 1 plus 20%. Okay. And then cost of goods sold, it's set percentage of sales, right? So you take this number multiplied by that 70%. Depreciation amortization, if I go back, was a percentage of last year, right? So for those, I need to write here. DNA is, let's see what percentage. So you take the 2022 number, you divide it by 2021's net PPE. See, that's what I meant. Because whatever ended at 2021, that depreciated in 2022. It's about 11.5%. So I'll keep it at this. So always better to have two decimal places. Okay. So let me show you how I do depreciation now. So my 2023 depreciation would be 11.49% of 2022 net PPE of 1,000. Whatever that number is, I will make it look nicer later. That doesn't matter. Operating expense, if it doesn't say anything, These are selling, general, and admin, right? It's all percentage of sales, remember. So it should be the 17% of new sales. That gives you your EBIT, which is your sales minus cost of goods sold minus depreciation amortization minus operating expenses. It's a good practice to also show gross profit if you are doing this for an assignment or for a real life project. Okay, I'm not using the dollar sign for now. I'm just using, let's say, 1 decimal point just to make it look nicer. Okay, now interest expense is similar to depreciation. So I need a number here. Okay, I need interest expenses. I will go back to the assumption just to see what does it say. Only for long-term debt. Look, here you could make an argument, Emrul, why long-term debt? Why not notes payable? It's possible. Then the assumption will tell you, or you can make an assumption. But remember, the interest that you pay in Canada for long-term debt versus short-term debt, which is notes payable, are not same. So they will tell you that it is this percentage of last year long-term debt and this percentage of last year notes payable, if you want to make it a little bit more real and of course complicated. But we are just saying these notes payable are not accruing interest for some reason, which is a bad assumption. Okay. But let's go with what we are given, right? So you're going to say interest expense divided by 2021's long-term bond. I think this number, yeah. So 2022's interest expense and 2021's long-term bond. Again, 15%. See, the interest rate is pretty high at this point. Okay. And just to always make sure you're taking the right number, because look, this is another thing the analysts need to always be aware of. If the numbers look odd, and then you see if I'm doing it correctly. Interest expense of 2022 divided by long-term bond of 2021, which tells me I probably should have added notes payable too, which is another 60, because this 15% interest rate is pretty high. And if I ask you to make a comment, you should make a comment on this, because if it's a US or Canadian company, they're paying very high interest rate. But anyway, it's 15% of last year's long-term bond. Some people do a iteration by doing it this year's because they say you pay interest on monthly basis, quarterly basis. I'm not going to the iteration. This is not really a core financial analysis class. I'm just doing this because if I ever upload the video on YouTube or anywhere, I want people to know that I know the regular financial analysis. I'm doing this for at a very basic way. Okay, possible. Anyway, taxes are 40% anyway, but I always like writing this number on top. I'll show you why. Mostly for sensitivity analysis. Okay, 40%. So your taxes are this times 40%. Net income before preferred share dividends. Just check if you have enough money to pay preferred share dividends. Why there is an error? But anyway, it's fine. 138.7. It is enough to pay preferred share. Last year they paid 4. The previous year they paid 4. That tells you I should be paying 4. So I just kept it same because preferred share dividends must be paid, right? If you have enough income. So 134.7 is your net income. Now a lot of other things are percentage of sales too. So I'm just going to find their percentages, or you can just grow them by 20%, whatever floats your boat or whatever way you want to do this. But I rather keep things a little clean. Okay. So this is percentage of sales of last year. This. And I know that C8 I need to keep constant. So I'm going to make it constant. And same thing, I'm copying now. Same thing for accounts receivable. Also percentage of sales now. I'm just making sure it's correct. Inventories, also percentage of sales. Or you can again increase by 20%. I'm keep saying this, okay? Another one here. Net PP, percentage of sales. Accounts payable, percentage of sales. Notes payable, we keep same. Accruals, percentage of sales. I always have to make sure when I work with Surface Pay, I'm doing things right. Yeah. You can also drag it, to be very honest with you, but it will give you a wrong impression that everything is a percentage of sales. So I'm not dragging the numbers. And we keep the other things same. Okay. So percentage, maybe 2 decimal points. Okay. So now I do cash equivalents, 0.33% of this year's sales, or you could, again, I keep saying this, increase by 20% if you want to. Short-term investment, we keep as same as last year, nothing. Accounts receivable is percentage of sales. Again, you could just copy and paste by fixing the cell also. Let me show you what I mean. Just makes your life a little faster. So I'm fixing that cell, which is sales, right, of that year. So I can just copy and paste whatever was supposed to be percentage of sales. Same for inventories, but you should check. You should, like, if you're doing this for the first time in your life, should always check. Look, it's increasing by 20%. So you need to be aware of what you're doing as an analyst. All of them are percentage of sales. I'm just checking again. Yeah, D37, B37, and we keep the rest same. Okay. I should also write something called common share dividends here. But am I paying dividend? Do I have to? Did I say anything? No, keep it just zero for now. So that will be called change in retained earnings. That should add to your balance sheet. But look, if I tell you that company is going to keep their paying their preferred common share dividend too, you need to just take that number if I give you a number. Because this is why these informations are provided, right? The last year they paid 57.5. They could pay this year too. And you can also make an argument that, you know what, every year they're paying 53 million. These numbers are in millions. So this is 53 and then 57.5. You can make an assumption that, okay, we're going to grow the dividend by a little bit too, because it's growing every year. The reason I'm putting zero, because we're trying to measure or calculate external funding needed. If the company is already generating internal fund and their external funds are expensive, they're paying 15% interest. So why would I issue common share, long-term bond or anything? And why would I even pay dividends unless it's been promised in AGM? Okay. Remember one thing, common share dividends are not payable. You don't have to pay that. But if it's announced, it becomes dividends payable. Keep that in mind. Okay. So total current asset, I could just use the sum. I know that for people who are Excel guru, I'm just showing this to you. Again, increasing by 20% makes sense. PPE, total asset is just. So how do you make an assumption of that? You need 2,400 million or 2.4 billion to sustain that growth that we saw, 20% growth. Now here, notes payable, we keep same as last year. That gives me total long-term bond, we keep same as last year. That gives me total liability. Preferred stock, keep it same as last year. Common share, not issuing any. Return earning is tricky. Last year's return earning plus this year's addition. Addition, you can call it change in return earning or addition to return earning. 900.73. So company is internally funding $134 million by retaining. Why would I take more money, right? So from outside, preferred share, common share, return earning, that's my total equity. Liabilities and equity should be this plus that. Am I right? Okay. So see, balance sheet doesn't balance. So I'm going to call this EFN, external funding needed, as I need 2,400 asset to fund the 20% growth minus, however, my company's general common liabilities are these. So I need 225 million extra to grow by 20%. So now the question is where the money comes from. I don't know the notes payable or anything. If it was negative, I'll tell you what to do. But if it's positive, that means you need more money. I'm going to make it bold and red. If I just, the main idea is if I want to balance, you could just go here, notes payable, do this last year, plus 225.27. That's zero, right? No funding needed. So you're basically, if you need funding, it comes from notes payable. And if you have excess, let's say what if total asset is less than total liability? That means you have excess money, it should go to short-term investment. Okay, that means you have extra money, you're just investing in some short-term mutual funds or whatever the companies do, or whatever your company's cash management policy or portfolio policy is. So, okay, I'm going back. So, guys, basically that's how you find EFN. What kind of complication can arrive? Some people do quarterly payment, whatever. Then you need to add more sheets here. And by doing different loan amortization schedule, different depreciation schedule in real life, this is done for an MBA level course or undergrad intro to finance level course, where we're not going to go deep into financial modeling or analysis. Why I like Excel assumptions to be on top or in a connected sheet, let me show you. Before that, I do this. Now, to grow by 20%, you need about, sorry, I got muted for a second. Let's say you're presenting it to your CEO or CFO. They will say, look, if you want your 20% growth, because CEOs are not necessarily don't know too much about finance, but look, majority do, that's why they're CEO. Let's say your assumption is we're going to grow by 20%. I'm going to say I need $22.226 million to grow. But if they say, what if we grow by 10%? So you can always just go and change here. This is why I like sales to be connected, okay? Or you can do best case scenario, just copying, pasting, worst case scenario, etc. See, everything changes by itself. This is why your sales should be linked. And it makes sense. You need less money now, 68 million. So you can tell boss, we need 68 million. What if they say, I don't want to grow. I'll just sustain what we have because of different interest situation, companies back. Now you have negative, you have 88 million money internally generated, and you can make an argument now, boss, I think we can pay a dividend. We can pay 57.5 million dividend now if we do not grow. I think that's why they have been paying some sort of dividend before. What about 5%? I want to see, just play with it. You still have $10 million, right? Available. What about 8%? Now you need 36 million. So that is, I can know 5 to 8% making a difference. So let's do 6%. About 5 million fund you need. This is a billion-dollar company sale, so they will get it. What about 5.5? I know it shows 6%, but you know what I mean. Like now you have extra money. So basically, this number also have meaning. I will tell you. What about 5.25? Let me show you this as 2 decimal points. What about 5.25? You have extra money. So some people make an assumptions here. What 5.35? I'll tell you what it means. You still have 4.69. Maybe I won't talk about this in class, that's why. So you can grow almost by 5.5%. Still have money. Oh my God, I'm gonna write 5.5. Okay. So do you understand? I can do this iteration, keep going. Balance will, but budget will balance. I mean, not budget. I'm an economist, right? So your balance sheet will balance. Still, you have some money left over. You do not need external fund, and you can still grow by 5.5%. This is a concept called sustainable growth rate, which means the company can grow by about 5.5 or a little bit more 5.52% or something through internally generated fund if I do not pay dividend. Okay, this is fantastic, isn't it? So that's why we do EFN. Hopefully you enjoyed the video. Okay, so let me know if you have any question, and if I upload this on YouTube ever, let me know if you have any question in the comments, or let me know in the class, and wherever you see me, what other assumptions you can play with, etc. Good luck.